Our next guest still believes that the U.S. economy is just a notch away from a recession. David Rosenberg is the chief economist and strategist at Gluskin Sheff Associates. He joins us now from the TSX with a little bit more. Obviously, they're taking a pause today with Memorial Day, David, but you're thinking a lot about the U.S. economy right now. Give us your sense on where things are headed.
Well, you know, the headline for the first quarter, you know, that has everybody thinking that the U.S. economy is so strong, and I think you would even mention that in your earlier comments about how this plays into the Bank of Canada. The reality is that, you know, when you strip out plunging imports, surging soybean exports, bloated inventories, and a jump in the Pentagon budget in the first quarter, all basically non-recurring items, you strip that out, and the underlying U.S. economy barely expanded at a 1% annual rate in the first quarter. That's certainly something I think that the bond market completely understands. And now we have the venerable entities like the New York Fed and the Atlanta Fed down to barely more than 1% for second quarter real GDP growth. So see what's happening is that the underlying guts of domestic demand in the United States, I described in the first quarter, that weakness, well, GDP growth is converging on that weakness in the second quarter. And so I don't know if you want to call 1% type GDP growth in the United States is something that's robust. That's news to me. It really is called stall speed growth. And unless we start getting some exogenous positive shock that causes that to reverse, the U.S. economy is going to be vulnerable towards heading into recession in the second half of the year.
Now, David, to your credit, you were pretty early on this call expecting that there would be a rate cut at a time where excuse me, most have thought it was roses and sunshine for the United States economy. But now consensus is where you are, expecting that there will be a rate cut at some point this year. But when you listen to the various members of the Federal Reserve, they seem to be stopping just short of that line. Do you think eventually that they will have to capitulate or come around to what the market is pricing in, or it'll be the other way around?
No, well, I think that, you know, we've seen this movie play out before. And Jay Powell, despite the fact, you know, I think that he's actually a fresh face and a credits guy running the Fed. But as an institution, it's very slow moving and very incremental. So, you know, we could have bought into the rhetoric from Alan Greenspan in early 2001 that all we were seeing was an inventory correction. When we found out ex post that it was actually a deflationary detonation of the technology capital stock, and you would have asked me, well, you know, Alan Greenspan is saying this, and so the job of the economist is to stay ahead of the curve. Or you would have said to me back in 2006, 2007, well, you know, Ben Bernanke is saying that home prices never decline nationwide. The problems in subprime mortgages are small and contained. Don't worry about anything. But again, you know, these central bankers, sometimes I think they have to get out of their models and look what's happening outside the window. So all I know is this. I know that the Fed raised rates 9 times. They pushed the envelope as far as they could to do what? To build up as many bullets in the chamber to fight the next recession, and they went too far. It's probably the only thing I will ever agree with Donald Trump on is that the Fed overstepped. And the shape of the yield curve is telling you that. Something else, by the way, is people marvel at the stock market, you know, hitting new highs. Just a month ago, it's rolled off that. Everybody talks about, oh, the S&P 500 is only 4% away from its highs. But take a look at some of the domestic sectors. I mean, we can understand, you know, why transports haven't done well, why commodities recently haven't done well, because that's the trade story. But why is it that the small caps, which are related to domestic demand, why are they back in a correction terrain? Why are the regional banks, again, with the heartbeat of the domestic U.S. economy, why are the regional banks back in correction mode? And of course, there's various segments out in the yield curve now that have fully inverted. And telling you a consistent story here, which is a story we've seen before. The Fed over eases, and then the Fed over tightens. The Fed over eases, the Fed over tightens. And yet again, for the 10th time since 1950, the Fed over tightened. And they're going to have to unwind a lot of that. So where I disagree with the markets is that the markets have one rate cut priced in. I think that when they start cutting rates in the next year, let's call it 12, 18 months, we're not stopping at one rate cut. We're going to go all the way back down to the zero bound in interest rates. So I think the market hasn't priced in enough is what I'm saying.
Just to come back to the stock market and what we've seen this month, and we were alluding to it earlier, it's true for the TSX, it's true for the U.S. markets, that going for some what are seen as safer names, whether it's utilities or consumer staples, seems to be a growing trend. What is your advice to stock market investors given your economic outlook?
Well, look, I think that if you have to be fully invested in the stock market, then you really want to be very much involved in defensiveness. That means minimizing the cyclicality in the portfolio. I think companies that have solid dividend growth, dividend yield characteristics with low payout ratios, perfectly acceptable. So you can actually create a select group of stocks in the stock market that would hold you in good stead. But this is a real time to cull the equity portfolio. Look, I think we have to go and take a look and see what the bond market is telling us here. It is a very important message because everybody just talks about the stock market as if that's the only asset market around globally. The yield on the 10-year Treasury note in the span of 4 months has collapsed more than 100 basis points. And that doesn't happen every single day. In fact, I would submit to you that more than half the time when bond yields go down this far, this fast, more than half the time, a recession, of course, a recession that economists and the central banks don't tend to see until they already start. Over half the time, when we have a move in bond yields like this, a recession is around the corner. And that means if you're going to be in the equity market, be as defensively positioned as possible.
Let's walk through the implications of your view that it's not just going to be one rate cut in the United States, that it's going to be multiple rate cuts going back down to the zero bound. What does that mean for Canada? Because right now the pricing kind of seems all over the place with a 30% chance of a hike in October and then an 18% of a cut. And I think people are trying to figure out those external factors in the United States with what has been a spate of better than expected economic data domestically.
Well, look, so Canada has had the grand total of 2 months of solid economic data. There's no doubt that the employment numbers have been stellar, but I've been saying for quite a while, you can't have it both ways because we know what output growth is really doing. So if you really believe in the veracity of those employment numbers, and it looks like the Bank of Canada does, then we have a really horrible productivity backdrop on our hands. So we have 2 months of data. Most of the data, you talked about retail and wholesale trade, very nice. These are lag data. The bottom line is that there's almost a perfect correlation between the overnight rate in Canada and the overnight rate in the United States. You know, the U.S. recession started in December of 2007. Our recession started about 3 quarters later, so it's just lags. The Fed got the ball rolling, cutting interest rates in the summer of 2007. Ultimately, the Bank of Canada was forced to go in the same direction. So if the Fed's going to be cutting interest rates, and they will be going more than once, I would say historically, even in the benevolent soft landings, when you get slower growth but not a recession, the Fed never stops at one rate cut.
But do you expect
as the Fed goes, well, there's no doubt in my mind, as the Fed goes, the Bank of Canada is going to follow suit.
Do you expect that to be reflected in the tone of this week's meeting? The Globe's headline is the Bank of Canada should dial down its Debbie Downer shtick this week.
Well, I think that the bank probably will have some guarded optimism with respect to, as you had said, they'll mark to market their views on the basis of some of the latest data. There's no reason for them to downplay the employment side. They'll probably sneak in a comment, and we know that Stephen Polo's recently talked up the labor market front. So I think they'll put a brave face on the macro side. In terms of one of the things they have been expecting is capital spending to come back by virtue of the fact that the global trade frictions were going to somehow be alleviated. Well, that's gone the other direction. And we don't even know if the USMCA is ultimately going to get through the Democratic House. So those are still some, I think, nagging things that'll keep them on the sidelines. If you're going to ask me, will the Bank of Canada tip its hat and ratify expectations in either direction? I doubt we're going to see that. I think it's going to be, as it was in the last go-round, very much a stand-pat comment. But like any other central bank, when the winds begin to shift and the Fed starts to cut interest rates, and I think the Fed probably goes ahead of the Bank of Canada, the central bank here is going to be forced to follow suit, or we're going to have a strengthening in the Canadian dollar that the bank is probably going to want to lean against because of what that's going to mean for its bullish call on exports. So, there's different ways you connect the dots here. I'm not going to say that the Bank of Canada and the Fed line up at the same time. But I do think once the Fed starts to cut rates, they're going to go more than once. That's the important takeaway. The market's got not enough priced in, and that the bank will follow the Fed.
David, we're pretty much out of time, but I do need, based on what you're saying, I need to get your 12-month forecast for the Canadian dollar.
Well, don't forget that we also have a Canadian election in there for October, which could have some important implications. But I'd say that, I'll put it this way, I'm less bearish than I was on the currency, say, about 6 months ago, but I'm still quite bearish on it. I think that if you're going to ask me right now, on what side of a 130 to 140 range, I think that we will probably get to the high 130s or the low 70s on the Canadian dollar. That's what I expect to see. So I think within a broad range like that, my sense is that it's going to be more of a bearish than bullish tilt.
David, always good to get your perspective. Thanks very much for joining us. Appreciate it. David Rosenberg, chief economist and strategist at Gluskin Sheff